and ask any questions if you have them live or through the Q&A prompt. Good. So, you know, I'm going to start with thinking a little bit about money and kind of how do we start the money conversation? Because one of the things that's really critical around dealing with finances is basically really having the feeling that we have the resources and we are set up to think about it or to approach it from the right mindset. So I like to start and say, you know, why are we here today? Basically, because we all care about this aspect of our life. And I think it's very important to step back for a second and think, what does money mean for us? And also to kind of put us in that position of thinking some other questions about money that allow us to start understanding a bit better and get a little bit more knowledge on ourselves about who was it that gave us our first lessons about money? What did you learn when you heard about those lessons? What does enough mean for you? So some of these questions that you see on the screen help you define kind of that mindset around money and help you as well start the conversation about money with other people, because I think money is one of those topics that's very, very sensitive, especially because in many of our cultures and in much of the world today, many times money is linked to self-worth, and that makes it be a really difficult and sort of personal topic to openly talk about. However, the most important thing is actually to talk about it so that we can both learn from each other and experiences that we've had throughout our life on this topic. So let me move on to what I think are basically the 7 or the 5 areas around psychology and mindset that make it, that are the pillars really to wealth mastery. So first of all, I just mentioned the psychology and mindset, right? So and we'll talk about that a little bit more in a second. In fact, at the beginning of the coaching I do with clients, we really go deep into this topic because it's sort of like the baseline for then empowering each one of us to take action on this important topic in our lives. But then beyond that, there are all these other 5 areas that are important to take control of. So the first one is earning, right? So earning is about income. That's how much we make. And obviously, the more we make, the more we can save. So it's kind of the first pillar. Then comes spending, which is whatever money we have, how do we spend it? Do we spend it aligned to those priorities in our life? And do we spend it aligned to goals in our life that we have around our finances? And then comes saving, identifying how much we can save every day so that then we can grow and invest our money. And finally, it's contribution, because I do actually believe that giving is actually an important part of how we think about our resources and the things we have, how we can, one of the ways is to give back. I believe in this kind of circle of life that the more you give, the more you get. So it's important to also think about how much do we want to contribute from what we make. So going back to mindset, which is at the core of this keys to wealth mastery, it is important to know that basically how we act is driven by what we have in our mind, what meaning and emotions we give attached to different things in our life. And this does not just apply to money, obviously. So, the state of our mind is influenced by 3 really important factors that we can leverage to change it. The first one is language. The second one is focus. And the third one is basically physiology. How do we stand, or what kind of physical state do we bring at any point in time? And is that empowering for ourselves? So I think it's really important to think about how we think about money from these 3 factors. So firstly, it's language. How do we talk about money? Do we talk about money from an abundant mindset, or do we talk about money as something that's bad to have? And what do we focus on? Do we focus on being grateful in our lives for what we have and maybe on, the visions of what we want to have, or do we focus on it on like what we don't have? And then the third one is, physiology. When we are in a state, even right now, how do we how do we show up even when we are thinking, talking, and working on our finances? So moving on to that mindset topic, there is this basically thoughts and automatic thoughts that we have around money that I call money blocks. And money blocks are basically those obstacles that come up in our mind when we try to address the topic of money. And some of those may come from family history. Maybe we heard at home that rich people are bad, or that money is bad for some reason or another, or maybe those are beliefs of people that are actually close to us at the moment. Maybe we are closer, or some of our friends are much more focused on what they don't have than on what they have. And we have to remember that actually we are the average of the 5 people we spend the most time with. So think about, are those people that are around you empowering you to take action on your money? And so it's really important to identify those money blocks. Before we start to work on our money and our financial plans, we really need to identify on an ongoing basis, because obviously we face this on an ongoing basis. What are those thoughts around money, those money blocks that we have? Because clarity is power. If we understand what are those subconscious thoughts that are driving our decisions, we can then change them and actually take different decisions. So I have in the next slide here, we have, I really believe that abundance, actually, especially in our world today, which is going through such exponential transformation, and basically abundance is meant to be for everyone. There is enough for everyone to be had, basically. And so I would like you to take a moment and just take a look at these money blocks that I have identified here. I'm just going to go through a couple. For example, I can't afford that, right? So that may be one money block that you have in your mind. What about shifting that? Because the power is, you have to write your money blocks, and then you have to shift them. You have to change them into these money affirmations that are really empowering, that allow you to, be in a better place to take actions on your financial life. So what about you change I can't afford that to how can I afford that? Or maybe that expense is not aligned to my goals, because you know clearly what your goals are, what you're trying to get to. So you make a decision of not buying that thing out of a place of power, because you know that there is a bigger goal and that's why you're doing it. Or what about, I love this one because this is something that, I'm looking at the last one, that I will always have enough coming my way. Well, some people are very much focused on spending, and so they don't really take care of their money. So what about if we shift that, instead of thinking that you have to spend, and that, that makes you that gives you the assurance that everything is, that you will always have enough, but also that you just have the power to spend. What about if you shift that a little bit and you think of, I am confident in the generosity of the universe, but I will become even more abundant if I take financial action. So that would be another way to think about, I will always have enough coming my way, which is maybe more empowering. So for a second, I'm going to stop, and I'm just going to challenge you to take a moment and write 1 or 2 money blocks that you may have, and then basically try to transform them into a positive money affirmation. Okay. I think someone raised their hand, but I can't see who it is here. I'm going to keep going, and then we'll open for Q&A later, and hopefully I can take your question. So I hope you guys got a little bit of insight into what are some of those questions that you may have, or blocks that you may have, that you can shift and create affirmations for yourself that are really empowering. And I think one of the things I would recommend, which I have had many of my clients do, is if you have come up with an affirmation that you would really like to hold on to, I would say write it down and put it around in places around your house where like it's accessible, or maybe in a notebook that you use, that you can look at it once in a while to kind of empower your mindset. And I think you should do this actually on an ongoing basis. I find it very powerful to sort of evaluate where my money blocks in once in a while and then shift them. But now I'm going to move on to a little bit more around the goals. And basically, what is it that we're trying to achieve when we think about financial plans? Well, ultimately, the goal is to have passive income, I think. And this may be before or after retirement. So, because at the end of the day, even if we're planning for retirement, what is retirement? Retirement is the time where we're basically not working anymore, but we hopefully have enough money to make a living at the same standard of living that we were living right before we retired, or better, right? So I think about kind of the destination of financial success in kind of three different buckets. The first one is, how can I get to the point of financial security, which is the point at which I generate basically enough passive income to cover my most important needs. And those are defined like your rent, or if you have a mortgage, your mortgage, your utilities, food, and any transportation needs, if you have a car or if you use public transport, whatever that may be. And then your insurance costs, things that are really kind of basic to your life. And then you come to financial independence, which is covering all your annual expenses. Can you cover all those expenses that kind of keep your life wherever it is in terms of standard of living? And then you have this financial freedom point, which is there you kind of have beyond what you had originally, what you needed. So it includes defining kind of those luxuries and dreams that you have and being able to generate enough to cover those. Now, so then what is the path to get there? So one of the first steps, in my opinion, is to set up your own personal balance sheet. Okay. So what does that mean? In order to take eventually action on what you own in terms of either investing or, buying a home or whatever it is, you need to know what you have. And so the first step is to basically create your own personal balance sheet. And here is an example. So what does that mean? It means you basically have to sort of draw the list of all the things that you own. What are your total assets? So that would include anything from the value of your home, whatever you have on cash, if you already have investments, what those are, etc. And then you want to define what is it that you owe. Is there anything that you owe and that you want, that you need to pay back? And then the net of that is your net worth. So the total assets that you have, everything that you own minus the liabilities, is basically your net worth. And the goal at the end of the day is to grow your net worth on an ongoing basis, and to have a net worth that generates enough money via investments or businesses that you have built that cover, your expenses, as I said, and most of your expenses for financial independence. Oops. There. And now that we know what is it that we have, we also need to understand, how do we manage the income that we get? And at the end of the day, it's really important to do this, because I believe we have a good, if we are able to manage our money well, I feel like the universe, like somehow we will get more because we know how to manage it well, right? So we are using it the right way, and we take responsibility for it. So the first thing is, budgeting is really important. So having a really good understanding of where your expenses are going is key. And one way to do that is basically by sort of setting up different accounts that, you can use to save and then invest. So one example is, in terms of monthly income, one idea is to sort of give yourself 10 to 20% of your income to this financial freedom account. So optimally, you are kind of saving on an ongoing basis 20% of your income, and you use the rest 70 to 85% for your necessities account. And then as you see, I've also laid out like a little bucket of 5 to 10% for the give account. And perhaps 5 is too much for you right now, but what is it that you can afford to maybe give to causes or things that you believe in, missions that you believe in. But of course, one of the first things that we need to focus on is, if we don't have it yet, setting up an emergency fund. And an emergency fund is basically that cash on hand that we want to have for the rainy days. So we recommend that should be around 3 to 6 months of living expenses. That obviously depends in sort of like the country that you live in and the sort of type of social protection that the country that you live in offers. But generally speaking, that's the amount of money that we should have on hand, to face the rainy days. So going a little bit more into your income, I think it's really, really critical to show you this, because basically what I tried to show here is it's important for you to have an idea of where your money is going and what your budget is, and track it on an ongoing basis. And the goal of it is not really to go drive yourself crazy with your expenses, but if you set up a system and you know generally what are the buckets of money that you're spending money in, and you know that you're tracking towards those buckets, you also need to dedicate a bucket to savings, which is the 10 to 20% savings freedom account that I noted in the page before. So if you're able to save that and invest that, imagine this person, they make 3,000 euros on a monthly basis, and they dedicate about 70% to their financial freedom or savings account. If you start investing 25 until retirement at 65, this money every month, assuming a 6% annual return, that becomes over €1 million. So that is quite significant, right? And at the end of the day, it's about planning and kind of planning your income and really defining what is the highest amount that you want to pay yourself. I think it's also really important to think about this 10 to 20% almost as a personal tax, right? So we pay tax to the government because we have no choice. Is there any way you can create a little bit of, or a big reason why, to give yourself the same choice of sort of paying this personal income tax to yourself on a monthly basis? So maybe that frame of mind helps to put it in a different perspective. So, and I would recommend that you take a look after this at your budget if you haven't done so. And I know that that's something that MoneyCoach enables. So hopefully a lot of you are kind of well versed on that. But you take a look at what you are spending at the moment, and define, especially in the scope of the new year, define where else is there anywhere that I could actually take a little bit extra to save. And remember, one of the things about looking at our expenses is really thinking, is this expense bringing me joy? Is it aligned to my values? Is it what I want to be spending money on? Am I taking advantage of it? If it's like, for example, a subscription that you have to a gym or something like this, is it something that I can actually take advantage of right now? And then thinking about how, like the other side of the coin, if I, don't do this expense, what could be the potential joy that this financial goal, or that sending this towards my financial goals, can bring me? So this is one example, but for example, if you're going out to restaurants and you go out to restaurants several times a month, you say, okay, well, I'm not going to do it 2 times a month. I'm going to save that and I'm going to put it directly into kind of my savings. And you can see here, if you put those 60 euros a month, what does it mean over 20 years if you get a return of 6%? So there you have, you added another almost 27,000 euros to your savings. So why does this happen, right? Why does this money grow like this? So I think what is most critical is, if you haven't started investing, the most important thing is to basically start right away. Why? Because of the concept of compound interest. So what does that mean? And I love this quote from Einstein here, because it says, compound interest is the 8th wonder of the world, right? He who understands it earns it. He who doesn't pays it. And basically all of us can take advantage of this. Today, especially in our world, there are so many solutions, online solutions, that we can use, I'm sure in the different countries, that we can use to take advantage of to invest, to start investing. And that, what does compound interest mean? So compound interest means that basically I have 100 euros today. And let's say I invest them into an ETF, which we will talk about later. And by the end of the year, these 100 euros give me a return of 10%. So at the end of the year, I have 110 euros. Well, the beauty of compounding is that next year, when I get that 10% return, I'm not getting that 10% return on my original 100 euros, but I'm getting the 10% return on the 110 euros. So I've already made some interest the first year, and the second year I make interest on top of that interest. So compound interest is basically just exponentially growing your money. And that happens when you start investing. And why is it important to start investing? Because actually the time, like I said, the time to start investing is now. It actually doesn't really matter when you start investing. It's not as important as it is doing it consistently and over a long time. So this chart shows you the return of the path of the Dow Jones since 1984. Okay, and the two little circles are basically the two latest financial crises. So the 2007 is a global financial crisis, and this little bubble right here, close to 2019, is basically what we just went through during COVID. And despite all that, and this number is already kind of a couple months old, we have an average return of the Dow Jones of 9.7% per year, which means actually, as long as you have been invested, you will get this return. The most important thing is to invest consistently and to stay invested. Because if you have invested, imagine you had invested in 1984 and all of a sudden it's 2007 and the crisis comes and you're like, oh my God, I need to leave the markets, and you decide to cash out, that's when you make your losses. But if you had consistently kept investing, you, from the period of 2007 until the markets were back up to where they were before the crisis, which was around, I think, 2011 or so, or maybe a little bit later, that you would have gotten into the market still consistently over that time period if you had kept investing little by little. And taken advantage of that as well, which is why it's so important to do it on an ongoing basis and consistently. So now I'm going to go into the different types of asset classes. So basically, there are many different buckets or types of investments. The first one is probably the one we are most familiar with, which is cash or certificates of deposits, which are almost like cash. Certificate of deposits is basically a deposit we can make for a limited amount of time that we agree upon, and we make a little bit more money than maybe what we get on just having our cash in like a savings account. Then we have equities, and equities is basically stocks or shares in the equity of individual companies. And then we have, which is basically you own a piece of this company. It's like if you would divide the value of this company, the net value of this company, and you have a little slice of that pie, that's an equity. It's just a piece of the company that we buy. And then we have bonds. Bonds are fixed income investments based on us lending money to the company. So let's think of an example. Let's think of, for example, Mercedes-Benz. And Mercedes-Benz needs to go build a new plant. And for that new plant, they need 10 million euros. And so they go and issue a bond. And what does that mean? They go out into the marketplace and they say, I need to borrow money from people so that I can raise 10 million euros and go build this plant. And they issue this thing called bonds. And typically these bonds are like an IOU. So if you buy them, you will get the money back from Mercedes eventually at the end of a certain number of years, because bonds generally have a maturity. And on top of that, you're going to be making an interest on an ongoing basis on that, a coupon, so a return every year, because bonds typically have, they give you the return and maturity. Sometimes they are sold a little bit less at a discount. So let's say you buy 100 face value of a bond, 100 euros, you may buy them at a discount. So you may buy them at 98 instead of 100. At the time of maturity, this bond is going to give you back 100 euros. And on top of that, if the coupon rate for this bond is 8%, you will get 8% annually distributed to you, usually every 6 months, for over those 100 euros, which is the face value of that bond. So those are bonds. And then you have commodities, which is you can buy things in different ways. You can buy things like gold, silver, oil, coffee, different crops. Then you have real estate. We're probably also quite familiar with that. So it could be a home or a rental property. And then you have alternative investments, and alternative investments are different asset classes, which typically are called also satellite asset classes, like private equity, venture capital, hedge funds, and things like collectibles also fall in alternative investments, like art, for example, or collectible cars, etc. And so what are the vehicles? So those are the types of assets. And now you can invest in these types of assets through different vehicles. You can, for example, invest directly in stocks and bonds, but you could also invest in them as well as in commodities or real estate, even through mutual funds or exchange traded funds. And what is the difference between mutual funds and exchange traded funds? So mutual funds, typically the goal of a mutual fund is basically to deliver to over deliver or deliver more than a benchmark. So let's say you decide to invest in an US equity mutual fund. The benchmark of this mutual fund is potentially the S&P 500. So there's a team behind somewhere, let's say in Fidelity, which is a large producer of mutual funds, and they are trying to put together, the index is the S&P 500, and basically they look at all of these companies within the S&P 500 and they say, which of these companies are going to overperform the S&P 500, which are going to deliver more than the index? And they decide to pick and choose some of those companies and invest in those companies for these mutual funds. So it's a US equity mutual fund, and they are supposed to over deliver versus the index. ETFs are different. Mutual funds are typically called active products or, actively managed funds, and ETFs are called passively managed funds. And what does that mean? These are funds that just want to basically replicate the index and the performance of the indexes. So if you want to invest in US equities, you could buy US equity ETF that follows the S&P 500. And basically what it is going to do is follow the exact performance of the S&P 500. And many times they basically they replicate, they buy into the same stocks that are in the S&P 500, and they get to that same level of returns that S&P 500 give you. And what's very interesting about ETFs and why they have become so popular is because basically to manage ETFs, the effort to manage them is much less than it is to manage a mutual fund. And therefore they are much cheaper. So the fees are much lower. And here, this is a particular aspect. So I'm based in Germany, and this is a particular aspect important in Germany, and it may be called differently in other countries. But it's important to know that in order be able to buy some of these products like mutual funds and ETFs, we need to have a special account for this. So we need to set up either a depot account, which is basically a securities trading account. And that may be the case as well in other countries. And then moving on to other important concepts around investing. So the first one is risk, which is the potential of losing the value of your investment. And it's important to be aware that that potential exists and to know what our risk profile is. So how much risk are we comfortable taking? And I do think it's important to educate ourselves, because the more educated we are on some of these concepts, that kind of more safe we feel, right? Education and knowledge give us a little bit more comfort into what we are investing in. The other concept is diversification. So diversification is the idea of spreading your wealth among different asset classes. So spreading all the different investments into different baskets. And that is important because typically what happens is if there is a financial crisis, not all asset classes necessarily get impacted the same way, which means by being diversified, you protect the value of your portfolio. And the next big thing is fees. So it's important that we watch out for fees. That is really, really critical. As I said, mutual funds have not only fees in terms of management fees, but depending on the country, they charge you fees to get into the mutual funds and fees to get out of the mutual fund. So that can really take money away from your return on top of the ongoing management fees. And I think it's also important here to mention stock picking versus investing in a diversified portfolio, because I generally recommend that if people are loving stock picking, I mean, in order to do good stock picking, you need to dedicate huge amount of time. And you would actually believe that you are much better than the analyst in Wall Street spending tons of time trying to pick a stock that they actually put into their portfolio, which basically dedicate all of their life to doing this. So I think it's much safer and much smarter to basically invest a majority of your money in a diversified portfolio of ETFs and or mutual funds, and then decide a percentage of their money, a smaller percentage of your money, if you're really a stock picker and you really want to do it, to use it for stock picking. But for the core of your portfolio, I would suggest much more having a diversified portfolio of ETFs or mutual funds. And this is where this next slide I think is super important, because basically it shows you the most important decision that you will be making on your wealth. So remember how we had at the beginning set up our balance sheet. So after you set up your balance sheet, you have this bucket of money that you can, it's basically your net worth, and you have it invested in across different asset classes. And that decision, how you invest your money, is basically going to be your most important investment decision, because it's going to drive the returns of your portfolio. In this case, stocks are probably some of the more risky assets of your portfolio if you look at this portfolio, but they are also the ones that are going to generate more return. So you want to think strategically about how you split your asset allocation and which type of investments you're going to be investing in. And the younger you are, the more risk you can take. The older you get, because you have less time until you retire or you need the money, the less risk you can take. So over time, generally what happens is portfolios go from having early in life, a higher percentage of stocks, to diversifying away from stocks into bonds as the portfolio as the person gets older. And this next one is just really taking a look at an ETF, because I think it is important to start learning more about ETFs. ETFs are great vehicles. They've become extremely popular and they're relatively inexpensive. So this one here is just an iShares. iShares is a brand of BlackRock, which is the largest producer of ETFs in the world. And iShares ETFs should be largely available in most countries. At least there should be some that you could access via your local institutions or local robo-advisors, etc. And this takes a look at an ETF that is the S&P 500 ETF. And so, as I said, it would follow the S&P 500 index. You can see here on the bottom part, basically what the return of this ETF has been. So if you look at this, you see the 1-year return was 15%, and since inception, it's about 8.8%. And typically that's kind of in the range that I think of for returns on stocks. So returns on stocks are typically between, I would say, 8 to 10%. So for the long term, so this return since inception is very much in the range. So that's one thing to look at when you look at an ETF. What has the performance been? Obviously, first, what benchmark is it following? Which is the benchmark behind it? In this case, is the US, the S&P. It's reflected in the name. Then, and you can see here the benchmark index in the next page is the S&P Total Market Index. Here, what's also important to see is sort of the volume. So this is a this is a huge volume here. So that is a good kind of reassuring aspect of this ETF. It's basically 29 billion invested in it. Yes, and it's an equity ETF. So this is some more information on the ETF. You have the closing price, etc. And then we go on to the fees. So it's a super low fee ETF. It's basically charging you 0.03% or 3 basis points. It's really, really cheap. So it doesn't get cheaper than this to invest in the S&P index. So that's a very important thing to check. And then the next thing is, what are some of the stocks what are some of the holdings that are in this ETF? And you can see here the total holdings are, I'm just noticing the prior this here it says the MSCI World, but it's actually the S&P ETF that I showed earlier. The total holdings are 3578. So 3,578 stocks are in this portfolio. So actually, when you buy into this ETF, you're buying a diversified basket of 3,578 stocks, and you're just buying, by buying in it, a very little piece of each of them. But what's beautiful about it is that if something happens to one of these companies, the impact, like something negative happens, the impact on your portfolio is not going to be huge, but yet you get a benefit of all the growth that's going in the market. So I'm getting close to the end of my presentation. What I would encourage everybody to do, I really encourage everybody to start your money conversations, because actually money is one of those things, like I said, we don't really talk about, but it's one of the things that we would get most value talking about. From things like salary, how do you negotiate your salary increase? What could be your bonus this year? Understanding what may be some of the concerns you have about money, to, you know, how have you figured out ways to save more? Which providers are you using, particularly with friends in your own countries, because we have a very diversified group today. And how can you, you know, start, what are you doing for your investing, and keep learning. And don't forget, like, it's really important to track and celebrate your success. I personally track my net worth on an ongoing basis, and it's really nice to see how that changes over time. So I recommend you to do that after you get your balance sheet kind of in place. And I would encourage everybody to start now. Use the, you know, next few weeks. There will be a few weeks hopefully off over the holiday season. It's the best time to, you know, set the goals for the next year. And the most important thing is that, like, there is not just money coming from the money that you invest. There's also like happiness, as you can see from here. And this comes from like a BlackRock survey that was published this year. When we take care of our financial well-being, we could be 24% happier, 19% less stressed, and even more positive about our financial future, which at the end of the day ends up influencing the rest of our life. So yes, I'm gonna basically stop for a second, and I am just going to make sure that I check the Q&A. Perian, do we have the ability to have people ask questions live? No, right?
Yes, they can write their questions on the Q&A. I'm going to start first with a couple of questions. First of all, thanks a lot for taking the time to do this workshop with us.
Of course, my pleasure.
I'm going to start with a couple of questions that I have as well, and then people can write their own. So. Do you? Okay.
Mm-hmm.
Yeah.
Are you seeing? You? Yes. So there is a question coming here that says, can I invest half of my emergency fund in bonds with short maturity? Is it good? So generally speaking, I think that's a pretty good idea. Then you can get a little bit of interest on your on, you know, half of your emergency fund on your cash. One thing to watch out for is, you know, which bonds these are. So it's important not only that they have short maturity, but to think of who are the issuers of this bond, right? Because there are different types of bond issuers. There's like very safe bonds, which are typically called AAA or over B+. So these are different categories of bond risk profiles or types of companies. So if it's a highly rated company and it has a short maturity, I would say that's a pretty safe investment. But of course, if it's a more risky kind of what they call high yield or junk bonds, I wouldn't necessarily do that, because although they are short maturity, they could be very risky. So yes, that would be one way to do that. And there are, for example, in Germany, and there's an interesting provider called Raisin. They invest in government bonds, or they help you invest in government bonds from other countries that are not as safe, let's say, as Germany, and therefore the yield is a little bit higher. That could be an interesting thing to look at, for example, for a little bit of the cash.
I have a question, Andrea.
Yes,
before you answering the other ones.
of course.
How do you keep track of your net worth? What techniques are you using, or what special maybe applications, or I don't know, apps, or is just plain simple Excel and then combining everything into one?
I think there are more and more tools that can help you do this. I have a particular situation because I have assets in different countries, and today that's quite complicated to do. So I personally, because I have to add assets from different places in the world, I do it manually. But I think you may even do you have the ability to do that?
Yes, well, as a matter of fact, you can create an unlimited number of accounts in any currency you like, and then we can just show you your net worth in euros, for example.
Yeah, exactly.
Based on your country of residence.
Mm-hmm. Yeah, I think I would recommend people to use that tool. I do it manually because I have a lot of things that you can't even access directly, like 401ks and things like this in the US. So it's a bit complicated sometimes, but I think, there are really great tools for budgeting and tracking. And I would encourage everybody to check out this MoneyCoach tool, because I think it's super useful. All right, so I'm gonna keep going through the questions. The next question is how to train your mindset about money. Okay, so I think this is okay. I'm gonna deliver some of my secrets, but I train myself every day, not just on my money mindset. So I'm a very disciplined person in this case, and so I do these daily affirmations that I take time in the morning to do my daily affirmations. And one of them, it's actually, I'll say it out loud, and it trains my money mindset, and it gets me thinking also about goals. This is what works for me. It doesn't mean that it's what works for everybody, but I go in the shower, I take a cold shower, and I actually say this affirmation, which is, God's wealth is circulating in my life. His wealth flows through me in avalanches of abundance. All my needs, desires, and goals are met instantaneously by infinite intelligence. And I give thanks to God for all of my wealth now and for all of my riches, for I am one with God and God is everything. Okay, so I have a very spiritual approach to life, as you can probably imagine. And so this is how I train my mindset. But what I was saying is, what is it that works for you? Get inside yourself and define what are those goals, and not just the money goals, the life goals, right? Because money and life, they go hand in hand. So what are those goals that work for you? What are those goals that you have, and how can you start writing affirmations for yourself that work, and that you may put them in your shower door, that you may put them in your notebook that you use, that you may wake up in the morning to, that are empowering and that are going to not only empower you, because it's a virtuous circle, right? So if we do work in areas that we love and like, then we get more and we do a better job. And then if we do a better job, our income is tending to increase, and we have people that are having the same energy. So it's all kind of together. But that's how I train my mindset about money, and also celebrating successes. That's why I love tracking the net worth, because it's like, oh my God, right? And this is not like a 1-year project. That this is like we're doing today, hopefully serves you for the next 20, 30, whatever, just subtract the date at which you hope to die, and then for that many years, basically, right? So it's an ongoing training. In terms of books, I have a question that says books you would suggest. So yes, I have a whole bunch of books. I'm looking at them now because I have some in my office. So one of the ones that I love is Money from Tony Robbins, and actually I just bought a new book called The Path, which is by Peter Mallouk and Tony Robbins. I would recommend that one too, which I'm reading now, because it's very much like it was written this year after the crisis, so it has a very fresh perspective. I also love some books from Barbara Stanny, which are really, really empowering. Particularly, they're a little bit more focused on women. I love the books from the Cash Flow Quadrant, and for oh wait, I forgot the other one.
Robert Kiyosaki, from Rich Dad Poor Dad. Yeah.
Yes, those are some of the books that I would recommend. Can I talk about money with people I don't know? For example, a mastermind group. Whoa, that's a very personal question. I think, I mean, to be honest, since my mission in life is to actually help people with this topic, I love talking to about money with anybody, and so I find that super valuable. But I think it is important to find what's comfortable for you. Like if a mastermind group, because actually it's more like a kind of not very personal connection to the people is more helpful, then I would do that. And the interesting thing about that is you can maybe get very different perspectives, because it's not basically the perspectives that you're basically used to. So yeah, I think it's a definitely a very good idea, but I think you have to check what you feel comfortable with. What is a good investment and what is a bad investment, and where do I start? So what is a good investment and what is a bad investment? I think generally I would define a good investment as an investment that reflect what is a good investment for you, right? Because at the end of the day, a good investment is defined as to what actually works for you with your own conditions. So generally speaking, what I think is really critical is that you do some learning on your own for yourself. If you've never started like investing, I think the best place to start investing is, and if you just really want to try something initially and very basic and with little risk, but that will give you some kind of can give you some relatively safe, because it's very diversified long-term returns, I would start with like a globally diversified ETF. So a world ETF. That's how I would do it. But again, a good or a bad investment, it just really depends on how you see it, right? Like, for example, there are people who dedicate 10% of their assets to a diversified portfolio of angel investments. And yes, we would consider a bad investment one of those companies that is a flop and that basically doesn't work out, but they understand that that's one of the risks that comes along with that. And if they have a diversified portfolio of investments, one of those companies is maybe generates 8 times return, one generates 0 or like basically negative because you lose all of your investment, but the other one, so the average works out, and that's fine for you because you have developed this investment strategy. But going back to like the really basics, I would start by looking at ETFs, learning about ETFs, and really with a world, a globally diversified ETF. Probably something following, for example, the MSCI World. What is your thought of the US housing market considering all of the unemployment and the closing of local businesses? Is there a risk again? I definitely, so are there risks? Yes. I think the risks are slightly less in the US now that the political situation is a little bit more clear, and I'm very happy for the US. So I think that the risks are less than they were. And I think that, the way the markets have largely responded since the election shows that, those risks are sort of calmed down. And on top of the fact that now we have the vaccine, or a little bit more clarity on the vaccine. So therefore, I think the markets are a little bit calmer. However, I do think that we have not seen fully all of the impact of the last few months, and that it will still ripple through a bit. But remember that the equity markets are forward looking. So I think that the fact that they have been relatively on a positive note over the past months is a good sign. But I do think there may be some risk in the US housing market because unemployment is still an issue. A lot of these people have gotten a lot of help from the government over the past months, and that's going to wash out over the next months. So there's still a bit to see what happens. Okay, then what are your thoughts on crypto? So here, I'm really not a big fan of crypto. I think it's still very intransparent. And so if you are a fan of crypto, I would say, then learn it, follow it, believe in it, but don't invest all of your assets in crypto. I would say if you want to dedicate 5% of your portfolio to crypto, then go ahead and do that. But generally speaking, like, you should have a core diversified portfolio of stocks and bonds before you go and invest in crypto. That's like, from a long-term perspective, that's the smart thing to do. Crypto is basically, it's basically kind of taking a bet on things that we don't really have clarity on, right? So it's, again, like if you buy the stock of one of the company, like any stock that has gone bankrupt recently, but I'm just thinking Wirecard because that's top of mind in Germany. If you just have this one stock, and you have all or 50% of your assets, and that company goes bankrupt, you lose 50% of your assets. It's similar with crypto. There is a lot of volatility in the price, etc. Yes, there may be upside, but it's not diversified, right? If you have a lot of it in your portfolio. So first, a diversified portfolio of bonds and stocks. And if you want to dedicate some money to crypto, then, select up to 5% of your assets, all depending on how much, what's your net worth. Where should I start with ETFs? Okay, so it really depends on there is a ton of research online. So I would say, if you want to start learning about ETFs, just go online and really start looking at different resources. I love, so the iShares ETFs, which are BlackRock, they are super, super helpful, or super good, generally speaking, good products. You have to look at the individual product you will invest in, but if you want to start learning about specific ETFs, go to the iShares website, and there you can, understand a little bit more. But of course, the important thing to make it more actionable is to see what providers are in your base, in your home country. So I don't know if you could maybe note which country you are in. That would maybe, not that I would know all providers, but maybe I can give you a bit more guidance if you want to mention a country to the person who wrote the question of where should I start with ETFs. No, okay. Well, basically, I would recommend looking at some of the online providers or robo advisors in the home country or in your home country, taking a look online at what ETFs are, going to the iShares website, which is the BlackRock website for ETFs, maybe looking at other large ETF providers like Vanguard or Fidelity, so you can get familiar with these products. And yeah, that's what I would say. Any other questions? I'm just looking at the time. Oh, it's actually pretty good timing.
Well, if there aren't any other questions, I will thank you once more, Andrea. To all of you who followed us, we will share with you the link and the recording so that you can digest it. No worries about that. And yeah, if you have anything else, Andrea, to share with the attendees, you can just say it now, or we can discuss it later, and we can write it down in the emails.
Yeah, no, it's been a pleasure. Feel free to join in, to send me an email. You see there my email, andrea@aliceapp.de. You should also join our, we have a waiting list at aliceapp.de. So if any of you are interested in seeing more of what we will be coming out with, feel free to go there, and also on Instagram to find us there, and I'd be happy to remain in touch. So it's been a pleasure. Thanks so much for the time and the great questions. And yeah, I wish you all the best in this financial path.
That's care. Awesome. And from my side, let me just start the I cannot start the video. Okay, yeah, this is Perian here speaking once again, MoneyCoach. If you just want to practice what Andrea is saying, you can just go on the App Store and search for MoneyCoach, and you will find our product over there. But I'm sure that a lot of you have already installed the application. So looking forward to receiving your feedback and how we can make it better. Thanks a lot. Enjoy the rest of the day. Have a great evening. Bye.
All right, bye. Thank you.
Bye.